Hi, everybody. Welcome to our session. We're so excited to have such a great group of people out here today. We think we've probably got three kinds of people. We've got Ord America fans who we love. We've got Jonathan Kukin fans who we're going to start loving. And we have people like me who are probably freaking out about what's going on in the estate planning world with all of the new legislation coming out. I think we're going to have a great program for all of you today. My name is Brad Kohler, and I want to welcome you all on behalf of Ord America to this seminar. Ord America is a really important organization, and I know you're all here to hear Jonathan speak, but I just really quickly want to let you know, since we do have so many people who aren't from Ord America already, a little bit about what we do. You saw a little bit in the opening teaser, but Ord America is fundamentally an education organization, and it's focused on help lifting people out, sometimes people who are in the toughest kinds of economic circumstances, and it's helping educate them so they can improve their lives, the lives of their families, and more importantly, the lives of their communities. Ord America is helping, or World Ord is helping people in over 30 countries around the world. We have over 200,000 beneficiaries to the kind of work that we do. And so we're really excited to have you here. If you're new to Ord America, we'll give you some links later if you want to be able to find out a little bit more about what it is we do and who we are. I don't want to take too long though, because I know you're all waiting to hear Jonathan speak. So if you have any questions throughout the seminar, please feel free to put those into the chat window or your Q&A session. We'll try to get to those as best as we can. And with that, I want to turn it over to my partner in crime, to the brains behind the Planned Giving organization at Ord America, the National Director of Planned Giving at Ord America, and my friend, Robin Isaacson.
Thank you, Brad. And it's my pleasure to introduce Jonathan. Jonathan Kukin is co-chair of the Tax, Trusts, and Estates Department of Winne, Banta, Basralian, and Kahn, and has practiced exclusively in the tax planning area since 1987. He represents small and mid-sized companies, particularly entrepreneurs, with a specific focus on family-controlled, closely held businesses. His legal expertise includes corporate planning, corporate transactions, charitable planning, and comprehensive estate planning. He lectures frequently on estate planning, including sophisticated charitable giving for high net worth individuals and businesses planning for new and experienced business owners. He is extensively involved with communal affairs, having served as past president of Congregation Renat Yisrael. He previously served on the executive board of the Moriah School, the boards of the SAR Academy of Riverdale, Cardozo School of Law, and was awarded his JD from Cardozo School of Law and his master's in taxation from New York University Graduate School of Law. And it is so my pleasure to ask Jonathan Kukin, my friend and all-around good guy, to present today.
So good afternoon, everyone. Hope everybody has a great lunch in front of them. I'm just pulling up the screen share for now. Okay. Back one. So today is Wednesday, October 20th. As of Monday evening and through the day yesterday, I was going to sort of explain to everybody, well, this is what's out there, this is what they're talking about, but there appears to be very little chance of it passing since the Democrats are self-arguing with themselves. As I put my head on the pillow last night, I had an alert from the Hill that progressives see budget deal getting close after Biden meet. And I said, wow, Robin and Brad and Ord are going to be so excited because now not only are we going to discuss what's next for planned giving and estate planning, but it seems more imminent than not that some of these actions, some of these resolutions, some of this law is going to go in effect prior to year end. And for all of you out there, I would say stop eating your lunch, get off the seminar and go call your accountants and your lawyers to say, what do I have to do? Given that you're now dedicated yourself for the next 40, 45 minutes to listen with me, speak with me through your Q&A through the chat, let's try to give some highlights of what is happening. In addition to the Plan Giving Month, this is also National Estate Planning Awareness Week. So it's also a good time, even if you're not in the tax planning arena in terms of the dollars and cents that we're about to talk about, it's a good time to review your wills, your powers of attorney, healthcare proxies. And I cannot say enough about this organization, and we will briefly discuss as well some of the planning techniques that could be used to help your estate and also to help a great organization like ORT. So what's all the fuss about? Well, the recent changes in tax laws under the Trump administration is every married couple has a credit that is currently valued at $11.7 million. We round that off, and with what is known as portability, you as a family unit have $24 million that you can pass to children and beyond children without any gift and estate tax, okay? Leaving aside, because I don't want to get too involved in it today, if you came to me with a $50 million estate and you have children and grandchildren, I would say, great. If you're ready to do some real planning, I could still zero out your estate because you have what's known as the generation skipping tax exemption, which is the same amount as the estate tax exemption. So essentially, working with expert specialists like myself, you can have $48 million plus all the appreciation escape the estate tax situation laws. That being said, there's also a big issue with regard to what state you're in, which we'll be talking about. Most people who signed up are Jersey, Florida, New York. Jersey and Florida are now coupled with the federal exemption, and New York is not. So if you're a New York person, you should understand that New York does not accept what is known as portability. So it's not a family credit that I've been talking about at 24. It is a specific credit for husband, wife, or two spouses. It does not matter if you're a domestic partnership, then New York credit is $6 million. And there are ways to work within that tax regime as well. Okay, so what's the big deal? Well, the proposal. How will the government pay for the $3.5 trillion infrastructure bill, plus the overlay of the other $1.5 trillion? Even if they cut it down, it is going to dramatically affect the estate tax system. The Trump administration, $11.7 million, that expires no later than December 31st, 2025. So even if you say all these proposals are going to fall by the wayside, we are coming up to the end of 2021. At a minimum, you have 4 years to get your plan in place to take advantage of these credits benefiting your children and grandchildren. If the proposal, what is the proposal, is they're going to accelerate. They're not going to wait till 2025. They're going to allow it to finish out by the end of 2021. So this portal of time that may be up to 4 years from now may be 10 weeks left to take advantage of the estate tax changes. They essentially are accelerating the 2025 end of the tax time to the end of this year. Well, that means you got to really get your heads around it. You really got to sit down. It's going to depend on what kind of assets you own, portfolio accounts, vacation homes. There are things that could be done, but you really need to sit down with your legal counsel and your accountants and get ahead of the game, not wait for the game to come to you. On the bottom there, you see what I call the ongoing conundrum. The capital gains, one of the big factors we always take into account. If you gift something today to your children or grandchildren, and let's say you purchased it for $100,000 and it's worth $1 million today. So there's what's known as built-in capital gains of $900,000. Your basis of $100,000, and what its fair market value. If you gift it, you're gifting it at your whoever gets it is getting it at your current basis. So this way, if they would sell it down the road, they would have to pay the capital gains tax on the differential, in this case, $900,000. If you die with that same asset, then the $1 million asset is includable in your estate, but the estate gets a step up in basis to the $1 million. So it would put you in the estate tax system at $1 million plus your other assets. But if the family would sell it, there would not be any capital gains. There was a lot of talk about changing the capital gains transfer or delaying the step up in basis or making the step up in basis immediate. Even the House and Ways Means proposal has put that aside. So I'm not overly concerned any longer with the capital gains, but that is when we talk about with a client getting into the weeds, we look at every asset, not just what the asset is, where we think there's going to be a lot of appreciation, but what is the basis? What is the built-in capital gains? Do I want to, quote unquote, die with that asset, or do I want to pass it on now? None of this is, easy. That's why I say, will you be prepared? Don't sit around, get out there, be proactive. You go out and attack it in the way that you feel you need to best suit your family, take advantage of the tax loopholes that they're out there. And again, a charitable component can be very, very important in doing that properly. I always come back to this. What is estate planning? Well, I look at everybody out there in the audience and when I meet with clients privately and say, you spend your whole life making money, paying your bills, taking care of your family. Everything's very orderly. All of a sudden, people don't like doing estate planning because it makes them think of a death. Nobody's ever died because they did their estate plan. God's not waiting there saying, oh, they signed their will, I can take that, okay? So I'm very, very practically bottom line oriented. By doing an estate plan, you're taking control and you're telling your family how you want to divide your assets, who's going to be in charge in terms of executors and trustees, if you have children who are minors, who are going to be the guardians. So if you die with a will, it's called testate. You die with a will, that is called a testate estate. If you die without a will, it's called intestacy. Intestacy means you're allowing the state that you live in to govern how your assets are distributed. And that can vary greatly. Do not think it's just simply everything to the surviving spouse. Often it's half to the surviving spouse and half to the children. And if the children are minors, then you got to go into court and you got to go petition the court to make a trust for minors. And it becomes much more expensive because you might have to post a bond. You have to post a bond to be able to do that. And it just makes the entire process very laborious, very legally intensive, and a royal pain, if you know what I mean. So have your will, get your distribution provisions the way you want, appoint the people that you want. Do you really want a judge sitting there? Do you want your family members running into court saying, it should be me, I know what they want? No, you should be speaking with the knowledgeable people that you have on your professional team and making those decisions. I'm often asked when I talk about these $11.7, $6 million, and since I've been practicing, those numbers have run all over the place. Oh, Jonathan, I'm not that wealthy. And I start asking people about their house, and they say, but I live there. Just because you live there, if you die there, that house is includable. Life insurance, it is really a misnomer that it's life insurance, but it really should be called death insurance. But I don't think they would sell a lot of product if it was called death insurance. So life insurance is includable in your estate, and there are a lot of nifty things to do with life insurance to get it out of your estate. Your pension. Pension is a generic term. I don't care if it's a 401k, a 403b, a SEP, an IRA, a Roth IRA, a defined benefit plan, they're all pension plans. They have beneficiary designations. They're part of your taxable estate, but they are not part of your probate estate. So you have to be really careful that your beneficiary designations run with your estate plan, what you have in your will, but you have to be very, very careful. You think you're going to live on that. That's going to be your retirement plan. But if you die with it, well, that is part of your estate as well. And many people have very high net worth based on their pension plans, and they're not really recognizing the fact that it's includable in their estate. And when your family members start taking it out, they will then get hit with the income tax on what's normally known as the RMD, required minimum distribution. I think it's important to note, and this is more on the accounting side, that the Secure Act changed the benefit from somebody's life, actuarial life, to 10 years after death. So that's also an important provision to make sure that your beneficiaries are named in the appropriate fashion, and that you know that it's 10 years after death, with certain exceptions, surviving spouse, possibly children or others with certain extraordinary needs, special needs, and so on, that you could stretch it out longer. It used to be you could stretch it out during their entire lifetime. That's no longer the case. Charity could be a very, very important. One of the reasons a charitable contribution at death is so important is at death you get a dollar for dollar deduction for that which you give to charity. That is not true during your lifetime. In lifetime, you are subject to the percentages against your adjusted gross income. There are certain limitations. But at death, if you want to give a fair amount of charity, it could be very beneficial by reducing, if not eliminating, the estate tax that your family would incur. Granted, those assets are not going to the family, but the taxes are not going to the government. Again, it's a very nuanced, specialized area, but if you have charitable inclinations, this is the time to explore it. And that's also why I write in there, pensions can provide many benefits. Because if pensions are includable in your estate, they're income taxable as your family members take it out, there might be, if you're going to do charity anyway, your pension may be a great methodology, a great asset to use to give to charity. So then I usually then wrap up of saying estate planning checklist, it can be a rewarding experience. I hope I'm coming across as a genteel, and this is an easygoing manner. This shouldn't be scaring anyone. And when you really sit down and get involved in it, it can be a very rewarding experience. I know when I draft documents, we really try to provide as much flexibility for future unknown and unforeseen events. I'm certainly in the game to help save your family considerable value in taxes. And as I started saying earlier, by dying with a will that's properly drafted, you're trying to pass your assets effortlessly to those whom you wish to benefit. And without a lot of fuss, without a lot of muss. And by doing your plan, that can happen. Many people own life insurance and annuities. This, again, is a very important component of your estate plan, and it should be viewed. Should your life insurance be held in trust? Should you have a charitable beneficiary? What are the cash value? What's the cash value in it? An annuity also, there's an annuity structure that can work very well for the family while you're alive, when you're gone. And as you'll see in the next slide, it's one of the big areas in planned giving. In planned giving, if you're considering a contribution to ORT, please contact Robin to discuss the attractive rates for a charitable gift annuity. If there are other things you want to do, you can make a charitable bequest in your will. Again, retirement assets, I think, is a very valuable area in terms of giving up assets to charity after you're gone. I've mentioned about no limitations on deductions. And then getting, further, and it's very unique to each client, what are known as cracks and clats. Charitable remainder trust and lead trust, giving you either income while you're alive or giving you a charitable deduction while you're alive. and certain amount of charity, certain amount of the asset going to charity after death. For my higher net worth clients, we look at private foundations and donor advised funds. What's new and exciting here? I've tried to lay the groundwork that the credit of 24 might become 12 million by the end of this year. One of my favorite techniques that clients are using, if you have a vacation home, I don't care what state you're in, but if you have if Florida's your vacation home, if the Hamptons, the Poconos, the Jersey Shore, there are some interesting techniques that we're doing to get the asset out of the estate, still giving you the ability to live there, vacation there legally, but then getting the underlying asset and the appreciation out of the estate. Today we might get into some of these techniques depending on questions and so on. I look at this as a broad brush, sensitizing you to the dollars and cents of what is necessary and what is available to you. As you see, we have little nicknames or acronyms for everything. A SLAT is a spousal limited access trust. It's pretty much after vacation home. These three are the big three. You have a vacation home, we either look at doing a personal residence trust or an LLC with voting shares and non-voting shares. The spousal limited access trust, we always refer to it, it's you giving up the asset, you're making a real gift, but you still have ability to dip into that asset while you're alive. So proverbially, I call that, is this having your cake and eating it too? And an ILIT is an irrevocable life insurance trust. Essentially, for most of my high net worth clients, if you own life insurance and you want to get it out of your estate, is what I have always referred to as the black hole of estate planning. It's a method to get it out of your estate at very low values and not be includable, so that would still give you the full credit that we keep talking about. Currently, this 11.7 for a husband and wife for each of them, and possibly changing 6 million by the end of the year or no later than 2025. So if you walk away with anything today, in addition to some information and knowledge, if any of these techniques seem to have some play for your plan, you should be asking your professionals, how does this fit? How does this work? Will this work for me and my family? So this is my summary slide about, there's the federal tax, there's the gift and estate taxes are now, once again, it is a combined credit. There was a time where they've been separated, now it is combined. And I made reference before what we call the GST, that's the generation skipping tax exemption. And that is when you would ostensibly skip over your children and give to your grandchildren and beyond. Interesting side note, this is how some of the families back in the 20s and 30s, Rockefeller's one of them, the GST didn't exist. So what they did with all of their properties, they would bring their children into the business, skip the children at death, give it to their grandchildren, and there was no taxing. And their children would then skip their children, give to their grandchildren, the great-grandchildren of the original Rockefeller. Well, the IRS eventually catches up with that, and that's why they put in the generation skipping tax out after the exemption. So again, there are things that can be done, but they have to be looked at, designated, and really dealt with. Your annual exclusion is $15,000 a year. You can give that to any individual you want. So a couple can be giving $30,000 a year to X number of kids, grandkids. How to do it, different question. You know, outright gifts in a trust, membership interest of an LLC. And if you have a large family, then there's another method, another bite at the apple, if you would want to pay for non-reimbursed medical expenses or educational payments. If the kids are in private school, parochial school, they're in college or graduate school, there are ways to do this. Remember, this is not for a parent to pay for a child. This is really second generational planning, because a parent has to pay for kids' school. But if you have grandparents who have wealth and maybe they don't want to make large gifts to the family overall, if we can convince them to make some educational payments because the grandchildren are in private school, well, A, it helps mom and dad out a lot. B, it helps out grandma and grandpa too, because they're reducing their estate by making those educational payments. So I made reference to this earlier about, is your state decoupled from the federal? So I said it's very state dependent. Florida and New Jersey are currently coupled. New Jersey was only in the last 2 years. In all my years of practice, Jersey used to be at $600,000 credit. Again, that's relative to this 11.7 that I keep talking about. So New Jersey used to have a state tax. If you were above 600,000, then 675, then $1 million, $2 million. But now New Jersey is coupled with the federal. So if you, as a couple, die with $24 million or less, there would be no federal tax, and there would be no Florida or New Jersey estate tax. And that's leaving aside for those people who their family members are not their spouse and not their issue. But if you are what are known as non-Class A beneficiaries in Jersey, New Jersey has an inheritance tax. Again, that is a very specialized concept. I don't want to take the time here because most people it does not apply to, but that's something, if you're a Jersey couple and you're leaving assets to nieces or nephews, anybody other than what we call lineal descendants, issue your children, then you need to be looking at that. New York and Connecticut are both decoupled, so if you're a New York or Connecticut resident, you have to be sure to really work the system to know that they are, New York is currently $5.93 million, and Connecticut is $5.71 million of credit. It is not the larger credit that we've been talking about if you live in New York or Connecticut. In addition to all of the tax planning, the wills, any kind of trusts, any kind of proactive planning, very important to have powers of attorney. Powers of attorney, again, I say it's residency dependent because I wanted to change the slide from staying state dependent. Every state has their own sort of unique. They all say the same thing, but they have, they make reference to their own state laws. Powers of attorney are for financial decisions while you're alive, but you're incapacitated on some level. They could either be immediate or they spring forward upon a disability. Sometimes you have to prove that disability, and we normally recommend for our clients to have the ability to make gifts, again, through whoever is their power holder. Healthcare is a power of attorney, but for healthcare, medical decisions. Again, it's not if you are capable of making that decision, it's what if I'm not capable of making that decision? And these days, if you have them, but they're 5 to 7 years old or beyond, please update them because they will not have current HIPAA language. So it's possible you have a healthcare proxy, and God forbid somebody's in the hospital, they may say you have the right to make these decisions, but we can't talk about the case with you or their medical situation because the HIPAA language to share that information with a third party is not in the document. And living wills, I generally refer to them as you do not want to be kept alive by artificial means. And this is a very personal decision. I can tell you countless times where clients are coming in to sign their wills, their trusts, their powers of attorney, healthcare proxies. They told me to prepare living wills, and they sit there in the meeting and say, we're going to wait on that. It's a very personal decision. I don't care if you are a very religious person, Catholic, Muslim, Jewish. We also have, particularly with healthcare agents and living wills, we do have specialized forms that we use to take into account your religious desires or your religious laws as well. So that's an important thing to ask for. If that's important to you, it's important to me, it should be important to your attorney as well. A big area over the last couple of years is, well, what happens to my Facebook account, my Twitter account, my Instagram account, and probably most importantly, what happens to all my online access? Well, We provide for that in terms of getting you access in your capacity as an executor or trustee. But if you're going to keep a record of these things for your family, make sure they have your usernames and passwords. Otherwise they might get access, but it still might be a very complicated, difficult procedure. So it's a hot area. It's very important, but very practically oriented. As long as you are able to provide usernames and passwords, and that's simple enough. Cannot tell you how many times people simply give me either a sealed envelope with the information or a USB piece that we keep in their file, and that reveals it after they're gone. Okay, so very important. Contact information for myself, Robin, and Brad. Here I'm really opening up the floor to any questions, anything more specific from any of the panelists or any of the people who are attending the seminar. And I very much appreciate your time. Look forward to hearing from you today or in the future. And certainly Robin and Brad are here for you today and in the future as well.
Great. Thank you so much, Jonathan. That was amazing. My head is spinning from so much information. And I would encourage, if anybody has questions, please type them in the chat and we will try to get to them. But I actually, I was taking notes and I do have some questions to begin with. And of course, my first one has to do with philanthropic giving. You did talk about it. You talked about that it's a good thing to do and that it should be included in anyone's estate plans. But could you go a little deeper and explain perhaps the better methods to make charitable gifts during your life and or at death? You glossed over it, and I thought that was really important, and many of our donors, I hope, might be thinking about that.
Right. Well, look, the most tax efficient gift is making a commitment and having it paid at death because of the dollar for dollar deduction. However, again, it's very case sensitive. If there are large capital gains and you're ready to get rid of that asset, if you give it over to charity, you'll get the full tax deduction for fair market value, and the charity will get the full value. It will wipe out the capital gains. I mean, that would be the big one during your life. Is you have Apple stock, and the same example I gave before. You bought it you have $100,000 of stock, that's your basis, and it's now worth $1 million. And you're ready to give up this asset to the charity. Sorry, I got distracted by the chat for a second. I'll come back to it. So you give the $1 million to Ord, you get a tax deduction for the $1 million, so it wipes out the capital gain, or it gets the $1 million. Yes, your family doesn't get the $1 million, but everybody benefits if you're willing to give charity. Okay, so I see one question in the chat says, you made it sound like life insurance is taxable on death for the recipients. And is it, was the question. The answer is, if your life insurance policy makes your estate a taxable estate, then yes, it will be part of your taxable estate. That's why we try to remove it by having it in a trust. It's not taxable just because it's life insurance and you die with it, but it is added into the amount of your estate. So for example, under today's example, not tomorrow's example, you're at $24 million of other assets, and you have, I don't care if it's $1 million, $2 million, or $5 million or more of life insurance. And you thought, well, I'm not getting that money, I'm dead. It's what's called incidence of ownership. If you owned it, it's part of your estate. So that extra $1 million all of a sudden would make your estate go from a non-taxable estate to a taxable estate unless you do something about it, okay? Next question was, can you talk about revocable trust versus wills? Yes, I can. It's a very also state-sensitive topic, meaning if you're, it's state-sensitive and fact-sensitive. I've had a fair amount. In fact, one of them from a seminar I did with Robin a couple years ago. A very nice single individual, never married, no kids, and New York resident. And New York probate is a very complicated, tricky area. And he and I discussed that having a will and probating the will when he had no family heirs at law, it was better to put his assets into a trust to avoid that issue. So that, again, was very fact sensitive, okay? The issue about a revocable trust, if you need privacy for your family, then a revocable trust can work very well. The big thing to do though is if you're gonna have a revocable trust, you need to put your assets into that trust. You're gonna have probate anyway. If you don't put something into the trust, then at death, you probate the will. The will is called a pour over will, and anything you have left at death will go into the trust at that time. So if you're not going to be proactive about putting the assets in the trust, then I ask you, what's the point? Because you can get to the same goal by just having a will with what's known as in your will. If you have children or spouses, second spouses, it doesn't really matter. The different reasons why you do a trust. If you have a trust in a will, it's a testamentary trust. It's not active until you pass away. So you can still have the trust concept, but you don't need to do it while you're alive. There are certain times and circumstances based on state and personnel that a revocable trust makes a lot of sense. So generally, it does not do anything for you from estate and gift tax planning. That I will take that right off the board. If you think by putting your assets in a revocable trust, it's out of the estate, that is completely incorrect, wrong. Do not do it for that reason. Okay? Do you need a will if you have a trust and all your other assets have beneficiaries? Yeah, you still need a will because I cannot tell you how many times you forgot about some checking account, some asset. I put it this way. If it was my client, I would want to have a will just in case, because you never know what's out there. If everything is in a trust and it's owned by a trust, and you say, I don't want a will, well, my letter would say the client demanded that they wouldn't have a will. And, and if all your other non-probate assets like qualified plans and life insurance have beneficiaries, you don't necessarily need a will, but I don't think it doesn't hurt you by having it. And if you have a trust, it would be what we call a pour over will. Literally, just think of a pitcher of milk pouring into the trust after death.
There's another question, Jonathan. You spoke earlier about seeing your financial planner, your accountant, your lawyer. If somebody is just starting to think about this, who should, for lack of a better word, quarterback this situation for them? Who do they go to first? What do they expect from each one? Do they all work together? Like, how do they navigate this?
Well, good question, whoever asked it. And, well, I know you asked it now, but you're proffering for someone. At the end of the day, okay, again, it's fact sensitive, where the client came from. Sometimes they want the accountant. If it's a very income related type of family, then the accountant is really going to be the quarterback because we're doing things to generate tax deductions. Sometimes it's the lawyer. I know that I pride myself on being a team player. I don't care who's the quarterback as long as we work together. All I ever care about all my years in this firm is we are here for the client to serve the client's needs as best as possible. And whoever is going to take control, I'm going to be very factual. Doing this, 35 years. The accountants and financial planners are, when I say more important, not more important in terms of the professional, they're more important because they have close contact with the client on a daily, if not weekly, certainly quarterly basis. The lawyers are usually the ones called in, okay, we're ready to move. We need you to do something. What's your input? Sometimes it's the lawyer. They just say, we have a little less skin in the game because we're not selling product and we don't have the return. But in general, I would say that the financial planners and accountants play a much more important role because they are daily in contact with the client, or more often in contact with the client than than the lawyers. But they have to be a team effort. Okay.
The next one, please talk about paying premiums on insurance in life insurance trusts and how to plan under what may be the new law.
Right. So the normal rules of the, I talked about the black hole of estate planning, and that is getting life insurance out of the estate. Now, depending on the size of the policy, okay, those premium payments are gifts. I mean, where that's going is those premium payments are gifts. Normally, people who are doing this kind of planning, they have a fair amount of children and or grandchildren. So we try to utilize the annual exclusion gifts for life insurance payments so they don't have to pay any gift tax right away. And if they have more premiums and they have beneficiaries, then we would use some of their annual exclusion gifts to keep the asset out of the estate. Right now, again, the life insurance lobby is very strong. So even if it's a trust, it's a little unknown right now what the law is going to say about an actual life insurance trust. I guess not that we're having a follow-up seminar in the next 10 weeks, but let's listen out and let's pay attention. Or if something comes out, maybe we'll get a missive together from Ort and my office saying this is how life insurance trusts and policies are being dealt with. But the question's a good one because those premium payments are considered gifts and they have to be accounted for.
Who should one consider appointing as a fiduciary? And I guess the terms guardians, executors, trustees, the difference, how should you consider that? And I guess also there's the question, if there's more than one, child, and, how do you deal with all that?
All right, good question. I might shock all of you once again. I tell my clients with young kids, money's money, but your kids are more important than anything. So the guardians, who's going to raise your children? Remember, we're talking about a very terrible situation. And in these days, 9/11 is becoming a little further in the past, but at least we've all been around. 9/11 had, greatly affected. Parents were on planes and children. I had a lot of cases back in the day. People who didn't do their planning, so sad, but we were in court on behalf of the children. So the point is, don't think it's just some kind of academic exercise that I'm talking about. So, I will grant you, there is nobody who's going to be as good of a parent as anybody who's in the audience, okay? But the point is, you're not here. So who's going to raise your kids, okay? So that person is the guardian. I then usually get asked, well, if they're important enough or good enough to raise my kids, why shouldn't I let them manage my money and give distributions to the kids? You're not incorrect. This is not a legal preference. This is a personal preference. Meaning, I try to guide my clients. I like checks and balances. I like the best person suited to raise my children, and I want them to go to another person to get money for my children. I call that checks and balances. A trustee is the person who manages the money. Doesn't mean they have to be a money manager. They have to be smart enough to go hire a money manager. Or money managers, depending on the size of the estate. They're the ones who are no different than you doing, investing your funds in different types of income and growth. They do that. And most importantly, they'll make distributions to children based on the ages or the timing or whatever provisions you have in your trust. So the guardians and trustees, they really are most important. They go for the longest amount of time. The executors, they're the people who marshal the assets, get you through probate. Who do you choose? Again, I break this up into 3 categories. If you have family or friends that are capable of doing the job, there's no reason not to appoint them. If you say, though, I don't want to do it because it's going to cause too much dissension within the family if I appoint one and not the other, then my next level is you look at what I call your professional advisors. Not necessarily the ones that you are actually using to do your plan, but the people that are lawyers and accountants and financial planners in your in your hometown, personal friends, because they have a license to lose, they have malpractice insurance, and ultimately, if they're professionals, they know they're going to do what's right, okay? Leaving financial professionals now are pretty much restricted. Under FINRA rules, you cannot appoint your financial planner. So, but it doesn't mean, you certainly can appoint your lawyer or accountant who you've been working with, but you do not have to. Not just that you don't have to, I'm just saying they fit a category if you move away from family and friends. If category 1 and 2 don't work, then you're looking at a financial institution, a bank or a trust company, and under certain circumstances, they work as well. And then Robin, part C, D, or E of this question was, I'm appointing more than one. Well, look, one is easy because one makes a decision. I decide to appoint all 3 of my kids. Well, it's supposed to be that they all agree, but ultimately, if they don't, majority rules.
Okay.
In most states.
Okay. And my last question, unless anybody else types something in the next few minutes, what about tilting of assets? Does that matter?
Oh, you mean titling of assets?
Yep.
So it used to matter a lot. It matters less so in the coupled states. It matters a lot in Connecticut and New York. When the idea, I didn't gloss over it in a way because I didn't want to talk about it. I just didn't want smoke coming out of anybody's ears. The concept of portability, it used to be that everybody had their own assets and it mattered who owned what. So in the old days, if and not to sound provincial, but it used to be 1950s. Husband went out to work, mom was raising the kids. Husband had all the assets in his name. Wife probably had very little in her name. So under that scenario, the husband had the $24 million in his name and the wife had 0. If the wife died first under the old rules, then there would be no tax but no usage of the credit. And when the husband died, just because they were under 24, it didn't matter. They would get taxed on the amount above the 12 million, okay? It was only in the most recent enactment that portability came around. Portability came around and said, as a family unit, you're 24, we don't care who owns it, we're giving you a $24 million credit. Yes, you got to put it on an estate tax return and things to do to make sure to use the spousal exclusion, but it didn't matter who owned it. But in New York and Connecticut, it does matter because they are decoupled, okay? So I saw another question pop in here. What's your strategy, people of less than a $6 million estate? Well, if we're not doing tax planning, you need a will, you need a power of attorney, you need a healthcare proxy. And then depending on the circumstances, the facts and circumstances, if we're not planning that you have to do anything for a taxable estate, you should at least be planning for an orderly distribution of your estate.
Okay. Well, I think that concludes our question and answer. I'm going to call upon Brad, the chair of our Plan Giving Committee, to say a final thank you.
Thank you very much, everybody.
Thank you.
All right. Thank you. Thank you so much, Robin. Jonathan, thank you. That was fantastic. Great information. I learned 2 really important things. First, I should probably unbury all of that cash that's in mayonnaise jars in my yard and do something a little bit more proactive with it. And secondly, I should probably eat less mayonnaise if I want to be able to have an estate and live long enough to build it up for my family. So thank you so much. We really appreciate you taking the time to help us out, to give us all this great advice. I also want to thank Robin, who made this whole thing happen, coordinated it, got us all, got Jonathan in here for us, planned the agenda, and just did a fantastic job. And finally, I want to thank the person who you haven't seen so far, Larry Ludwig, who is our producer behind the scenes, making sure that you can see us and hear us and are having a great experience. So Larry, thank you to you as well. And I want to just sort of close by taking a step back. Jonathan gave us some outstanding information about the considerations on how do you make sure that your estate is protected, and how do you make sure that you're going to be able to pass on, the maximum to whoever you want to do that. The thing I want to start with, though, is it's really important to think about, before all the mechanics, what am I trying to accomplish? what is this legacy that I want to leave? Who do I want to take care of after I'm gone? And certainly, and Jonathan mentioned that we want to take care of our families. There's no question about that. But there's opportunities in some cases to look beyond that. And that's a place where we just wanted to remind you that you might want to help take care of ORT. And planned giving is a really interesting kind of giving. And it's something that I've come to learn as I've been on the committee. It's different than what I would call regular giving. I'm used to people soliciting me for things. They're having a building and they need money to build the building. Or they have a new program and they need money for the program. Or they're going to tell me I could feed some kids if I give them some money. And it's really clear what my money is going to. Planned giving doesn't fund things. Planned giving funds dreams. Because right now, today, we have no idea what ORT's going to be doing in 40 years. We don't know if we're going to need money for a building. We don't know what programs we're going to be funding, but we do have a dream. And that dream is really simple. Our dream is that we have a world where the circumstances in which people are born do not have to be the circumstances in which they die. And to fulfill that dream, it's really simple. And it's been simple for a long time. Educating people is the best way to lift them out of whatever circumstances they happen to be in. So we just wanted to say, if you share that dream, and if you have the means, after you've taken care of your family and friends, if you want to be part of our dream to lift people from the current circumstances they have to a much better set of circumstances, please consider thinking about ORT. We're going to be sending you some materials. We're going to be sending you the presentation after the workshop. It's got some links. And if you want to just learn more about ORT America, for those of you who don't know about us yet, please feel free to check out our website. Thanks everyone for joining us on the seminar today. We hope that you got some great tips. We hope that you're going to be more comfortable trying to navigate all of these crazy waters that are ahead of us with changes in legislation. And most importantly, we hope that we've given you some ideas on how to protect the people and things and dreams that are most important to you. Thanks everybody. Bye-bye.